Hello, I'm Sally Baudet. Welcome to Global Business Europe. Our top stories. 40 trillion in the hole. US national debt hits another milestone, more than doubling in a decade. A US Treasury intervention in the bond market fails to soothe investors as yields rise once again. An economic D-Day against Iran. President Trump announces new sanctions to isolate and crush the Iranian economy. Taste for Italy. China cooks up new ways to market traditional Italian foods, part of a broader deal between the two nations. Now, US national debt has passed $40 trillion after doubling in a decade. As the government spends more to cover its budget deficits, the Treasury has announced an intervention in the bond market. Our correspondent Jagruti Dave joins us now from Washington, D.C. Hello. From the US Treasury Secretary Scott Bessent speaking about exactly this. What's he saying?
Hi, Sally. Yes, Scott Bessent told CNBC that the US could buy back more than $4 million of long-term debt. This was the limit that Bessent had originally announced on Wednesday. He didn't say how much more the buyback scheme would grow in size, but he said that that would be determined by the bond market. Now, bond yields briefly went down while Bessent was speaking, but they climbed back again. Now, yields are essentially the interest that are paid on bonds, and we've seen the bond yields, as I say, jumping up again. The 10-year bond yield rose as high as 4.7%. The 30-year yield went up to almost 5.3%. Now, ING analysts are saying that all of this move announced by Bessent was like rearranging deck chairs on the Titanic. And that's because it doesn't reduce the amount of debt the US government owes. It just shifts the balance to more short-term debt over long-term debt. And that's important given the broader context, as you mentioned, of the US government debt breaking the $40 trillion barrier.
We're also hearing that the Federal Reserve is open to potentially raising interest rates. I would imagine Donald Trump won't be very happy about that. But what's their reasoning?
No, and he's long expressed frustration that the Fed isn't cutting interest rates, saying it's the way, in his view, to help economic growth. He's criticised former Federal Chair Jerome Powell for keeping interest rates, as he's put it, artificially high. Now, he's recently been talking about this, expressing further frustration that the Fed isn't making more cuts. And he said that his replacement, Jerome Powell's replacement, Kevin Marsh, is doing a great job, but he's alleging that other members might be politically motivated in keeping rates high, although officials at the Fed have maintained their political independence throughout. Now, at the last Fed meeting, members said, and this was at the end of July, decided that they would keep interest rates unchanged at between 3.5 and 3.75%. But the minutes released on Wednesday show that more members thought interest rates should go up to bring inflation down to the Fed's target of 2%. Now, I should say that inflation is currently at 3.4% at the end of July, and that's cooled slightly from the previous month. And we know from the minutes that 3 Fed presidents have voted against holding the rates steady. What's interesting about these recent minutes is that it shows that most Fed officials thought that inflation would cool, but many thought that it would still stay elevated because of rising energy prices from the Iran war and the long-term impact of the president's tariff policy. So this is significant because it shows divisions among the members, and that despite previous cuts in interest rates, clearly keeping their policy tight is still on the table.
Thank you so much. That's our correspondent Jagruti Dave in Washington, D.C. Now, let's bring in Vicky Price, international economist, joining us here in London. Hello, Vicky. So we've had some quite strong comments from Scott Bessent in the last hour or so. What do you make of it?
I think it suggests to me that they are worried and that they want to calm the markets, because the cost of just servicing the debt. It's not just a case of, and worry, of course, that everyone has about the size of the debt, but it's also what is it costing to just pay the interest on it, which suddenly last year amounted to over $1 trillion. And I think that's quite significant, as you can imagine. We've also got, of course, the issue of the actual deficit being rather larger than what had been promised, because, if you look at the the most recent president, but also what was being attempted at the end of the Biden era was to try and reduce the deficit as a percentage of GDP. Well, I'm afraid that's still about 5.5%, and that is another worry. So is there anything in the pipeline, if you like, which is going to be possibly reducing that deficit in the future and do something about reducing also the debt pile that's out there and therefore the cost of servicing it? And for the moment, just the action that we just heard about buying perhaps one's own treasury bills and doing that in a bigger way than was originally intended, so 4 billion a week rather than just 2 billion a week, isn't going to do it by itself.
Besant also said he thinks that bonds have hit peak yields. Do you agree?
Well, who knows? I mean, if he says so, then he must have something to bring to the table. The question is, of course, whether the bond markets think that, in fact, debt is going to continue to increase. The other question is whether they think that inflation, even though it's just been reported by your correspondent, has been coming down a bit, whether, in fact, that is just temporary because we still have the problem of oil prices being very high. If you just look at the market today, we saw Brent crude up to $93 a barrel. It's been showing no sign of really coming down. And if anything, if you look at what's happening in the market in terms of yields, they're going up, not just in the US, of course, but more generally. So I think the markets are taking fright. They're moving to other types of investment that they want to put their money into. And that, I think, is a concern in terms of funding the debt at relatively low interest rates in the future. It looks like it's going to be rather difficult to do.
At what point would America's debt actually undermine confidence in the bond market and the dollar? Are we even close to that?
Well, it's interesting you ask about the dollar. Of course, what everyone is saying is that if you look at the US, it can just print more money. It can do all the things that Scott Bessent said he's going to be doing. The Fed can intervene and perhaps, buy more bonds in the secondary market rather than reducing the amount that it's holding already, which is, of course, in the trillions. It has reduced them, but it stopped doing so it may be more accommodating. But generally, of course, we're not talking about a country that is going to default, and therefore the bond markets are unlikely to get particularly worried to the extent that there will be a crisis. But there is no doubt that if you look across the world, there is a retreat from funding government debt. And I don't think it's going to be affecting just the US, I'm afraid. Some countries might find it a lot more difficult to deal with the situation. But a weaker dollar, of course, adds to inflation. And that is going to be a worry that of course, President Trump is going to have. And, of course, the Fed, which may want to rethink its interest rate stance, as we've just been discussing.
When we look at this $40 trillion hole, it's nice to point a finger of blame. And I'm wondering how much of this growing debt is bad luck. I'm thinking pandemics, the global financial crash, natural disasters. And how much is bad choices, overspending, starting wars, that sort of thing?
Well, I'm afraid it's a combination of all these things. There is no doubt that because of COVID, well, it all started with the financial crisis where there was an extra, trillion or two which had to be put into the economy. Then we had COVID, and there was a big budget stimulus which was given to the economy, particularly by Biden. There was a little bit also by Trump. That has again been in the trillions. And then, of course, there is the issue of what's going on right now in terms of President Trump himself cutting taxes and giving more incentives for the economy to grow, which, of course, has affected the amount of revenues that he's been collecting. And the other unfortunate thing, perhaps, is that the economy has not grown as fast as had been expected because you can't cover that debt and you can't cover the actual interest that you have to pay on your debt. If the economy does well, the economy has done perhaps better than some other countries. But if you look at what's going on even this year, the last quarter has seen annualized growth of just 1.5%. It was over 2% in the first quarter. And there are serious concerns as to where some of the money that you need in terms of taxes to reduce some of the deficit that I spoke about is, of course, going to come from. And then, of course, you've also got the repayment of the tariffs now that they have proved some of them to be illegal, which has cost an extra, 160 billion, maybe a little bit more so far. So it all adds up, I'm afraid. So it's a series of, yes, accidents, but also some deliberate mistakes.
Thank you so much. Vicky Price is an international economist based in London. Now, China has urged the United States to scrap plans for tariffs on imported drones. Beijing says the measures unfairly target Chinese products and threaten global supply chains. The White House recently imposed tariffs of up to 100% on imported drones and components, citing national security and supply chain concerns.
The US measures overstretched the concept of national security, impose differentiated tariff rates on trading partners, and discriminate against relevant Chinese products. They seriously harm the interests of Chinese companies, disrupt the order of the global drone production and supply chain, and further undermine the market environment based on fair competition.
Alibaba's year-on-year revenue climbed 9%, almost $40 billion in the last quarter. The Chinese tech company's AI, cloud and compute services enjoyed the fastest growth, with profits up 133%. Overall, though, net profit fell 75% as investment soared by a similar amount. Qian's Hong Kong stock market debut has been put on hold until next month. The online retail giant was due to list next week, but investor interest has been slower than expected. It's now targeting a valuation of between $26 and $27 billion. Just 4 years ago, in 2022, Qian was valued at nearly $100 billion. The founder of Chinese property giant Evergrande, Xu Jiayin, has been sentenced to life imprisonment. He pleaded guilty to embezzlement and bribery, and his personal assets have been confiscated. The sentence comes after Evergrande's collapse, which triggered a major crisis in China's property market. This is Global Business Europe. Still ahead, an economic D-Day against Iran. President Trump announces new sanctions to isolate and crush the Iranian economy.
Everything is a business story.
Welcome back to Global Business Europe with Sally Baudet. Your headlines. 40 trillion in the hole. US national debt hits another milestone, more than doubling in a decade. A US Treasury intervention in the bond market fails to soothe investors as yields rise once again. Now, President Trump has declared what he's called the most crushing economic operation ever against Iran. He also said he'd impose sanctions on any country that does business with Iran. Tehran has dismissed the threat, calling it a diversion from America's own crisis. China has called for restraint from all parties. While Iranians have endured economic sanctions for decades, life has become increasingly difficult this year, with food prices really spiralling. From Tehran, our correspondent Ehsan Kevani reports on how families are trying to make ends meet.
Iran's economic crisis has entered a dangerous new phase. Official data shows annual inflation hitting 66%, but for the poorest families and disadvantaged provinces, that figure has already crossed into three-digit territory. Economists warn that Iran has entered what they call a period of economic misery.
Price tags are outdated before the ink dries. Shopkeepers can't be blamed. They're racing against a clock that ticks every minute. But for shoppers like me, it's chaos. I calculate at the shelf, pay more at the counter, and walk away with nothing but dissatisfaction.
For millions of Iranian families, putting food on the table has become a daily battle. With food inflation peaking at nearly 130% last month, staples like meat and dairy have become luxuries. The national currency, the rial, has plummeted to record lows, eroding whatever savings families had left. Desperate times have forced millions to take on second jobs. Teachers, government employees, and factory workers are now spending their evenings driving for internet taxi services just to cover basic expenses.
Skyrocketing prices are breaking us. As a retiree, my pension increases are meaningless. And when they can't keep up with inflation, I'm having to borrow left and right just to survive.
Pass by any butcher shop and the prices tell the story. The rich don't notice, the poor can't afford it. That's where we stand as a country. The officials offer slogans, they talk about protecting people's livelihoods, but for millions of us, that livelihood simply doesn't exist anymore.
But perhaps the most telling sign of this crisis is how Iranians are being forced to pay for their daily bread. Once reserved for cars and high-ticket items, buy now, pay later schemes are now being offered for meat, dairy, detergents, and mobile phones. Billboards from companies like SnapPay line Tehran's streets, advertising installment plans for groceries. Delivery services are even advertising half-sized portions of traditional dishes.
Every day, customers pick up an item, glance at the price, and put it right back.
Look at these shelves. They're full. The problem isn't supply. The problem is right here in my hand. This jar of mayonnaise now costs more than many Iranians earn in a day. So they walk in, they look, and they walk out with nothing. That's the real story of Iran's economy today. Ehsan Keibani, CGTN, Tehran.
As we saw in Ehsan's report, inflation in Iran is now at 66%. But the spiraling cost of food is of particular concern. The price of cooking oils and fats have risen more than 260% in the past year. That's astonishing. Dairy products, milk, eggs have increased by 147%. Now, shoppers buying meat are paying 145% more than they were a year ago. And the price of breads and fruits more than doubling in that time. All right, let's bring in Professor Mazia Ghiabi, Director of the Centre for Persian and Iranian Studies at the University of Exeter in the United Kingdom. Mazia, thank you so much for speaking to us. How much longer can ordinary Iranians cope with these prices?
Hi, and very good to be with you. Iranian households are past the point of simple tightening the belt. The situation is really dire, very difficult, and it's been very difficult for the past few years. But now the prospect, the horizon ahead of them seems dramatic. There is also a level of exhaustion, because it is something to tighten the belt for a year, 2 years, and something when the prospect of it goes for longer. And inflation and the data that you gave, it speaks for itself, of course. We are talking about basic commodities, the everyday commodities of life, food, cooking oil, and all of this actually in triple-digit inflation. I think we are in a very dramatic situation, but of course, you know,
Iran has had sanctions placed on the economy for decades. How much has the war impacted?
The war has escalated that situation. Of course, not only sanctions work in layers year after year, the effect of them is not a single historical event. It goes on and they build up. But the mitigation strategies that Iranians and the Iranian state have put in place were further under pressure because of the war. Of course, the war creates also situations of mutual help, of solidarity, and sort of rallying around the flag, which we've seen in Iran. And to a certain extent, that has had also effects on mitigating the extraordinary economic damage that the war has caused.
Yeah, and now we know President Trump is threatening this economic D-Day, even more sanctions. Politically, any kind of resolution seems to be at a bit of a deadlock. What are Iran's options economically to make life livable for ordinary people?
I think contrary to the past, as you said, there is very little hope that a settlement, a diplomatic settlement, can be reached with the current U.S. administration, the interests of which are mostly dictated, it seems, from Tel Aviv, which is the only country that actually sees the proliferation and continuation of the conflict as a positive sign. What impact do you see this having? The state will need to come up with some strategy, some form of strategy. One would be, for instance, to try to eradicate as much as possible levels of corruption within the Iranian socioeconomic system. The other is, as I said earlier, triggering forms of grassroots mutual help on the basic commodities, trying to create an economy that sustains the very basic demands of the Iranian people, and also trying to expand what has been successful in the past, informal networks, especially with neighboring states, particularly Iraq and Pakistan.
All right, thank you so much for speaking to us today, Professor Mazyar Ghiabi, Director of the Center for Persian and Iranian Studies at the University of Exeter. Now, Chinese consumers have developed quite a taste for traditional Italian food and other products over the last 10 years. Now, a new trade deal between the two nations will see Chinese e-commerce platforms boosting Italian produce even more. Here's our correspondent, Hermione Kitson.
Since 1817, the Gradassi family has been producing premium olive oil in the hills of Umbria. Today, that tradition is travelling far beyond Italy.
We started working with the Chinese market about 10 years ago, when olive oil culture in China was in its early stages and there were only commercial oils. Since then, the market has developed significantly.
Marfuga is one of many Italian companies looking to expand in China thanks to new trade agreements. An Italian Foreign Ministry mission in April led to a new Made in Italy strategy focused on agri-food, machinery and luxury goods. The aim is to also boost the presence of these products on China's e-commerce platforms.
Our products are available on JD.com and Tmall, and through these channels we're also communicating that olive oil is not just a condiment, but is also valued for its health benefits.
The growth trend of Umbrian exports to China is much stronger than that of other Italian regions. It's a strategic market that we need to invest in.
The agreements will also strengthen partnerships that have been developing for decades. One example is OMG Sicoma, an Umbrian manufacturer of concrete mixers. The family-owned company entered the Chinese market in the year 2000, establishing a joint venture in the city of Zhuhai in Guangdong province.
From 200 mixers in 2 years, then 500 and 1,000, up to 4,000 mixers in a year, reached several times along the last 25 years.
The model used in China has since been replicated by the company in other international markets.
From local producers to regional industry, these companies reflect Italy's push to diversify exports to China at a time of growing global trade uncertainty.
We have to find which are the very niche of market, in which the high technology, creativity and the quality of the products, Italian product, can be competitive.
From generations of family business and Made in Italy expertise, a new chapter of growth. Hermione Kitson, CGTN, Umbria.
Now, on Wednesday, US President Trump paused his plan to slap 50% tariffs on products imported from Canada. But with only a 3-day extension, time is ticking to make a deal. CGTN's Dan Williams reports.
The newly built $4.5 billion Gordie Howe International Bridge is the latest connection between Windsor in Ontario, Canada, and Detroit in the United States. But trade tensions between the two countries are testing ties. Many businesses across Canada are breathing a sigh of relief after avoiding a new bruising set of tariffs, at least temporarily. It follows the announcement by US President Donald Trump that he has paused 50% tariffs on around $20 billion worth of Canadian goods. The suspension is for 3 days, based on continued negotiations toward a new deal between the two countries.
Subject to the finalization of documents, we have a deal with Canada, and I think it's a very good deal for both parties. It's great for our farmers.
The news of a tariff pause was widely welcomed by locals in Windsor.
We're in a situation of having to make the best of a bad circumstance, is really where we're at. Sounds like a little bit of concession on both sides. Hopefully, it's a matter of not panicking, because at the last minute, things tend to change.
We should be able to stand on our own feet. Even if we have to tighten the bell a little, it's worth it. You know, we cannot depend on other people.
Windsor is among the regions already impacted by a host of tariffs imposed last year that remain in place. Those tariffs are focused on steel, aluminum, auto and lumber, among others. The latest round of tariffs would have targeted a range of Canadian goods, from cement and building supplies to dairy and even hockey sticks. Canadian wine is another industry that would be hit, though many local producers say the impact would likely be small. They cite minimal US sales of their products, along with a surge in domestic sales following provincial bans on US alcohol sales, enacted as part of Canada's retaliatory tariffs.
Tariffs is a tax. I mean, that's what it is. And the tax is paid ultimately by the consumer.
Steve Ondeco is president of On Freight Logistics, a Windsor-based trucking and logistics company.
Certain industries are certainly hit very hard with the tariffs and the cost of the tariffs. And, you know, trying to offset those somehow and keep the business working in Canada has been a struggle for some industries.
Despite recent trade tensions, the US and Canadian economies remain deeply intertwined. The two exchanged some $720 billion worth of goods last year, but that figure is down 5.5% compared to 2024.
I think the world is on pause, and the business world is on pause, and the investment in new business is on pause until this is resolved. Business will not invest money in a short period of time, for a short period of time. Businesses need long-term visions.
The announcement of a tariff pause has brought relief, at least temporarily. But in the long term, the hope for many here is for a more comprehensive deal that brings greater certainty. Dan Williams, CGTN, Windsor, Canada.
The headlines again. 40 trillion in the hole. US national debt hits another milestone, more than doubling in a decade. A US Treasury intervention in the bond market fails to soothe investors as yields rise once again. And an economic D-Day against Iran. President Trump announces new sanctions to isolate and crush the Iranian economy. That's it for Global Business Europe. Thanks so much for watching. Up next on CGTN is Africa Live. We'll see you again tomorrow, same time, same place. From all of us here in London, goodbye.